All right, welcome everyone. We're just at 11 a.m., just after 11 a.m. here, and hopefully you can see my. I'm going to ask Chris to give me the thumbs up that he can see my disclosure up on the screen.
Got it.
All right, awesome. So as we always have to start these meetings, I'd like to read the disclosure as part of it. Today's meeting, 11/5/2021, with Beacon Capital Management, specifically Chris Cook of Beacon Capital Management, now a Salmons company. The conversation today, none of the investments are not guaranteed. Past experience is not indicative of future results. Clients may lose money. This webinar is created in November of 2021 and is provided by Tranquilli Financial Advisor and Beacon Capital Management for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or the offer to sell any products. Tranquilli Financial Advisor, Beacon Capital Management reserve the right to modify their current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that the assessments today of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account the specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. All right, so with that out of the equation, I would like to just admit other participants. You will hear some beeping in the background. I apologize for that. I'd like to say that I'm running the board, if you will, for our meeting with Chris Cook, and let me go there and start with welcoming Chris, saying hello to Alina Akram, our TFA communications intern, and Andrew Polson, our TFA finance intern, everyone on this call and other clients who are listening to it, and friends of those clients that may listen to it later. This wouldn't apply, but you will be receiving an email from the A team there, Andrew and Alina, in reference to your beneficiaries. So please be sure to take a look for that and respond to them. And if we have some work to do for you on beneficiaries, that's coming up. And then with the holidays coming up as well, we'll have some additional emails in reference to some work that we're doing for everyone. We'll say in the background that you don't see every day. So hello to Alina and Andrew, and let me properly introduce Chris Cook, who I can now say I have the benefit of knowing for a decade as part of Tranquilli Financial Advisor, working alongside Chris. I told the story the other day of his first office, which is not anything like the office that he sits in right now. It was great to meet him back then. Chris did a great job of answering the 20 questions that Lou Tranquilli had for him. He is the creator, owner, and chief investment strategist for Beacon Capital Management. We're really glad to have him here with us again. We're going to take about 40 minutes, cover a good number of topics here, so we're going to get to it in just a moment. Chris, welcome back. Thanks for joining all of us again as well.
Thank you. Appreciate it, Lou. Thanks everyone for taking the time.
Always a pleasure. And I will mention that Chris is a Bowling Green graduate as well. And my son, Jack, is at Ohio State University. And I am just about to drag Chris over to Ohio State University. He tells me that his feet burn when he gets to that campus, but he's going to do it just for me. So Chris, let's hop to it. And we've got a lot to cover, like I said. So I'd like to do so for everybody. And we'll start with the first topic, and again, I apologize if you see me looking left or right as I talk about these different pieces. But we decided to jump into, if you will, politics, which is always a bit of a dangerous territory. And in those politics, the conversation of taxes, it's front and center. Alongside now, Chris is aware, and I'll mention again, we had a good video conference that Alina is going to take the recordings of with Horizon on Wednesday of this week, and now this meeting today with Chris. We talked, I'll say, a little bit different element of politics or economy, inflation, with Horizon, Chris, we decided to talk about taxes today and really want to get to that. Taxes, capital gains, with such a strong 12 or 13 month period within the stock market. Little conversation on taxes, preparing for potential increase in gains. How is Beacon Capital Management looking at that? Anything changing? What's your approach to that?
Sure. So as of now, we're not changing anything, with our portfolios or in terms of the approach that we're working with. Thankfully, the folks over in Washington can't seem to get anything done. So that tends to be a good thing for most of us in our world. And when it comes to taxes, there are two sides of the tax bill that we are paying attention to. Though one is the corporate taxes. That does affect investment returns from the stock market, because it comes right off the bottom line for most of the corporations that we're investing in, which tend to be large companies. So now that has kind of been put on the back burner for the moment anyway. That's one of the reasons why the market is kind of popping up the last couple of weeks since that revelation has come into being. So that's a good thing, for corporate taxes. Now, of course, lots of arguments maybe why they should pay more taxes, but we're just looking at it from a very narrow scope, and that's how does the stock price do? What's good for bottom line? And that's a good thing that they're not going to raise corporate taxes.
And I think it's an important distinction from our conversation from a few days ago, in that you are a passive money manager.
Yes.
So you're investing in large corporations, and I'm going to ask you to define it rather than I will define it. But the concept being is that you're using the index, the S&P 500, Standard & Poor's 500 index, as the guide of what your portfolio is made of, but you're not directly investing in the S&P 500. So if you would explain that, because I think it's really important with a little calming down of the market. I do want to get back to that, but a calming down of the market nerves because of the political backing off of taxes. So I want you to comment on the makeup of the portfolio and why it's such a direct impact to a portfolio like yours if taxes increase as they've been.
Sure, great question too. So the S&P 500 is basically the largest 500 publicly traded companies out there on the New York Stock Exchange and otherwise. So it is market cap weighted, which means the bigger the value of the company, the more weight that it carries. And what makes us really different is, as Lou had mentioned, we invest in the same companies, but we weight them differently. We're looking at the sectors themselves. So when we say a sector, we mean like technology sector, the financial sector, healthcare, utilities, energy stocks, things like that. And we weight them evenly. So we don't really give an advantage to one particular area of the economy or the market over another. So right now, the S&P 500, we just look at technology itself, it's running about 25% or so of the S&P 500. In fact, if you really wanted to dig into it, 5 companies right now control about 25% of the S&P 500, the ones you'd expect, Apple, Microsoft, Amazon, so on and so forth.
Netflix, right?
Yeah. Yep. So, and if you threw Tesla in there, it's getting close to 30% if you went, past the FANG stocks. So that gives you a really heavy weight in particular companies like we talked about, and a particular sector, technology mostly. With Beacon, we're equally weighted. That tends to take some of the edge off when the markets get really volatile. Typically, when the market falls, it's because that one sector just gets way too big. The bubble, creates. We always hear about these bubbles. Well, that's what we're talking about. We're trying to protect against it. So when it comes to taxes, that will have an effect, on that with the market itself. If they're going to raise corporate taxes, you've heard the poster child, right? It is Amazon, right? They're just targeting them very, very directly. And even the bill, that's being proposed, well, apparently today the House may vote on it, is calling it the Amazon tax. So, in our case, we kind of take some of that weight off of that, so we won't get affected nearly as bad. But it probably will have an effect no matter where you go.
Of course, and to finish or add to that thought, the inefficiency and we never, how's this? We want to deliver to everyone the news, if you will. Mm-hmm. Sometimes the news is really good. In the last 13 months, the news has been really good as it applies to investing. And some of the news isn't quite as good. It's fair to say Beacon is highly tax efficient when we're in an environment like we're in. However, when we get into, let's say, a 2020, the February to March period, and the 10% stop loss kicks in, and you have Beacon as part of a non-qualified account, Beacon becomes tax inefficient because you are going to sell and move to bonds. I'm going to ask you to, again, as the person who sat down with the math and said, this is why I believe this is the way we need to invest this. Understanding taxes are an important part of things. And we're going to pay those taxes on the gains when a significant market drop occurs in non-qualified accounts. Can you talk about that for a moment?
Sure. Yeah. So, the first thing is the majority of investor dollars out there are qualified. So they're in things like an IRA and whatnot, where we don't have to worry about capital gains. But there's obviously a lot of folks out there that have taxable accounts. And you do have to worry about capital gains, which is why, I've been paying particular attention to, Washington and what do they want to do with capital gains. So, very pleased to see that they backed off, turning capital gains into an income tax, rate, that can push 40% or so. And, and then you factor in, state stuff, you're over 50 in some cases. Well, you guys there in New Jersey, I think you're probably one or two, right? In total.
We are.
Yeah. So, you want to pay really close attention to that. Now, where everything is at right now, if we go into a full blown, bear market, so that means the market, when it falls, 20% or more, those are the periods of time when we're really trying to protect the client. And whether it's a taxable account or not, the math still works out in that particular case. So just for a quick example, go back to 2020 when this happened, right? So we ended up getting out effectively on the last day of February of 2020. And we ended up getting back in pretty fast, actually, on the last day of March of 2020. Now, in that window, the market ended up falling quite a bit, depending on what you wanted to look at, somewhere between 30 and 40%, depending on which benchmark you wanted to look at and how you were allocated. Now, we didn't fall nearly that much, obviously. We were down about 14 at most. But when the market started to rebound very, very rapidly, we ended up getting back in on March 31st. So when we got back in, the market was still 14% below where we had sold out. So let's just assume for a moment, you paid 100%. You had a full 100% gain in your portfolio. So that means, you got to pay 20%, on half of your portfolio, that case. So that worst case scenario is you would be down, 10%. So we were still ahead of the market by 4 or 5%, depending on which market you want to look at after tax, just in that one turn. So, again, trust me, I'm the guy that hates paying taxes. Most of us do. But when it was all said and done, and I have a taxable account, I was ahead compared to if I would have just ridden this thing out on that day. And then since then we've been in, and the market's been nothing but up. And one of the things, we should probably bring out, since we're talking about 2020, between the end of March and now, but particularly towards the end of the year of 2020, the market did have quite a few gyrations in terms of going down. It went down more than 10% a number of times. We never actually stopped out again because that equal allocation that we were talking about before, it tends to give us a little buffer. It's our first line of defense. So we were able to remain fully invested that entire time and keep just chugging along. So to your point, we tend to be very efficient most of the time. And then when we're not, it's when we really just need to protect, against those catastrophic losses.
The concept of why Beacon Capital Management is in, I can't say all Tranquilli accounts because we're recording and that wouldn't be SEC compliant. I can say for the right investors, it's within their portfolios. So I do want to touch on a couple of pieces of that because again, I think it's so important conceptually to share with those on with us now and those that will listen after when we send this recording out. The equal weighting of investments within the Beacon portfolio is a natural buffer against things like the bubble that you were talking about. I know you already covered it, but I want to go back over it just briefly, if I could, as I like to explain it. So if anyone here were to look at their portfolio after you've say rebalanced it back to the desired allocation, you would see within the portfolio that you have 11 exchange traded funds with 9.1% in each one of those exchange traded funds. In our case, we're using Vanguard for all of them. I know you do have some others that you work with, but in our case, we're using Vanguard. So you would see 9.1%. So if you use the technology sector as a bubble sector, which it is right now, and that bubble is to break, while it will have an impact on your portfolio or client portfolio, it has call it a 9.1% impact on the client portfolio, not a broad impact because we're just randomly throwing money at the S&P 500, expecting it to go up. It's such an important concept from not only a growth standpoint, because on the other side of that, you're not fully participating when the bubble is up more than the other sectors. However, you're also not constricting the return because we are investing in the broad market. So on one side of it, we have a good protection by the equal weighting. On the other side of it, we're still participating, just not fully participating by randomly, if you will, investing in this bubble portion of the market. I think it's excellent part of the portfolio that isn't talked about enough. I'll say by me even.
Well, it really isn't talked a lot, about in the marketplace out there or on the media. So, I mean, the reality is today with 25% of the S&P 500 in technology, there are very few investors where they should probably have 25% of their portfolio allocated in what you could call the most aggressive sector of the market.
Like 5 of those stocks within.
Yeah, and then you narrow it down, like you said, it's even tighter. So, if we go back in history, our prior to the pandemic, we had the dot-com bubble. Technology, that sector itself was about 33%. So that was the biggest bubble ever, at that time. And, we all remember that didn't go so well. No. And then 2007 into 2008, the largest sector was financials and real estate. So that was about 30%, of the market then. And again, we all remember what was happening then. Everybody watched HGTV and we could flip houses, right? So that was the big thing. And that market, that sector grew to be almost a third of the marketplace. And again, that's what caused, the big downdraft that happened in the market. So, we're protected at least for a period of time. We may get pulled in with the rest of it like we did in 2020 with the pandemic, but that's why we have those next layers of protections built in.
the selling and into the bonds and everything else. We won't go through all the technical part of it, but it is part of the taxes, which is part of the current political environment. And I just want to touch back on that for a moment. Part of what I have to do as an advisor for clients is I have to make the decision of, all right, are we maybe going to move away from a beacon because we know they're going to sell, or do we do something? And I have already done so for clients in conversation with Chris and how we could handle this a little bit differently than automatically stopping out if we ever wanted to do that. And to Chris's credit, he's very responsive to I get a 1 o'clock in the morning thought, and Chris gets a 1:01 in the morning message from me, email from me saying we need to talk tomorrow. So anyway, we have not taken the approach on taxes to bring it back to that political conversation and the global, even the what's the framework agreement of global taxation of corporations. We have not taken the approach of selling based on, call it rumor, the prospects of a tax increase. We did not take that approach. And I will say that I'm proud of staring that down in 2021, because I happen to know that a number of financial advisors have been out there selling clients portfolios under the premise that in 2021, we'd have a higher tax rate. Well, we're likely to get a higher tax rate in 2022, but we didn't pay those taxes in 2021. And this is no self-congratulatory, pat on the back. It's just that we don't deal in rumors, and we shouldn't deal in rumors. And I guess it's the cautionary tale for those listening now and later on. Can't do it. You can't take that chance, because look at what's just happened. Mm-hmm. All right, good commentary. The market calming down. I want to finish on that for a moment. I had a few people call me up, and they said, "What happened?" Like not for a few moments. This is really our next topic. It looked like we were on our way. I had a few, several emails, several phone calls. Are we close to the stop loss? Are we getting close? Just some version of that question was coming at me. And then all of a sudden it stopped. And I had several people reach out and say, what just happened? Like, it looked like it was on its way down, and now all is well again. Mm-hmm. You explain to us, Chris, what happened.
Well, sometimes the market is kind of difficult to keep up with and figure out the factors that are actually driving, the direction, I guess. And effectively what happened, in the third quarter was mostly about people worrying about interest rates, and quantitative easing. So we hear about the Fed, right? One, they were going to start taking away a lot of the support that they were feeding into the marketplace, just every single week, just enormous amounts of money. And eventually interest rates were going to go up because of inflation. So, everybody sees all of these prices just skyrocketing, right? So they were going to have to deal with that. Well, since then, what's basically happened is the Fed has done a very good job at communicating exactly how they're going to do this and do it in a slow way. And they're sticking to their guns of, okay, we're going to wait until we actually see long-term, inflation. Before we start getting in the way, which basically pushes that conversation back into 2022 sometime. So the market started to rebound pretty quick. Now, the other thing that helped, honestly, was earnings. We started to see all the earnings come out, at the end of the quarter, and they're really good. They really, really are. And it's hard to think about that these companies are making more money now than they were in 2019. So if we just 2020, we all just say, yeah, we know what happened. We'll skip that. And how do we do compared to before the pandemic? Every single company basically is doing better now than it did then. In fact, a stat just came out of forecasted earnings from companies. And in 2022, every single company in the S&P 500 is reporting a profit as their forecast. Okay. That hasn't happened in 10 years. So every single company, all 500 are going to forecast a profit. Now in 2019, there were only 4 that didn't. That was the lowest number, prior to this coming year, that don't make money. So, we hear a lot of things in the media about what's happening. You've got supply chain issues. You got cargo ships just lined up in Los Angeles. All these things are happening. But part of these things are happening because we're buying a lot of stuff. Between the government and increases in the stock market and the housing market, people have money right now, and they are spending it. In fact, one of the things that helps the market too is that there is $28 trillion in cash in the United States. So households just sitting on $28 trillion in cash, and they're using it. Basically the net worth of every U.S. household is at a record high today. No other time in history has our net worth as a country been as high as it is today. And that's average. That's not just saying Elon Musk, he's making up all the money, right? It's all of us, So, and then because the interest rates are so low, we sometimes kind of forget that, different investment vehicles are competing for dollars, right? So, you've got the bond market versus the stock market. Those are the 2 big ones. Well, if you go to the bond market right now, you can't make anything. I mean, interest rates are virtually nothing, let's call it. The Fed has basically told us the only way rates are going to go are up. Well, that's a bad thing for bond prices. They're going to go down. So people will naturally push more money over to the stock market side of things. So that's, all the reasons why, the S&P rebounded and now it's just chugging off to new highs. So those are great things. Now, we'd probably be remiss if we don't talk about, what could go wrong. Of course, one of the things is we are highly valued. If these earnings numbers don't come in like all of the economists and the forecasters predict, well, the market will have to come back down. It'll have to adjust. Or if something happens, we will have to adjust. I look at Peloton last night, reported their earnings, and they basically have said, yeah, we're slowing down. We're seeing it. People are not just buying our bikes. Well, it's getting crushed today. It's down like 30%. So, that's just one company. It doesn't really make a blip in the market. But, if you start to see that in a bigger way, that will cause a problem, ultimately for the market. So, that is an issue that we have to pay attention to. And obviously, COVID, it's not done yet. So hopefully we won't have any, massive outbreaks, and have to, pull our horns in and shut down and, protect ourselves again. But it's not over. It could happen. So there's lots of risks out there. And then I guess the third one I just happen to think of because of our conversation is, Washington. It will be an election year next year. So, they'll probably try to make some bold moves to generate some votes. So, but again, that's why we will ride this thing. Our system, works in a way, our philosophy works in a way that we will ride the market as long as it'll keep giving it to us. But we kind of run right behind it with a little safety net saying, okay, enough's enough.
Sure. Like literally with a net, you're behind it. Now, and I know you brought up Elon Musk as your example of the 28 trillion on the sidelines. I thought you were going to share with everybody your balance sheet, Chris. So that's so, and and I sent out one of the short form videos, we'll call it the 3-minute videos, 3 or 4 months ago, about the tone of the market and what the tone of the market means, what it tells us. Some people would call it momentum. In my case, I like to use tone because I like music, but also just simply, I think it fits with the conceptually. Again, what we're getting at is that the tone of the market right now is to be in the stock market. And again, when I say market, I mean, I have to make sure that I say that includes bonds and stocks, even alternatives. We don't generally, as a matter of fact, we don't get involved in alternatives. However, the tone of the market right now is to be in the market. They're just, and Chris has just perfectly lined up the reasons why: low interest rates, earnings reports, politics, even a little bit out of the way for the moment, global politics out of the way. That was in discussion again. For those of you listening after the fact, make sure you listen to the Horizon video because we did have a pretty deep discussion about global politics there as well. They're out of the way for now. So all of these things line up to a stock market that propels farther. The concept, the theory, again, being different, Chris, that you have than others that Tranquilli Financial Advisor works with. That's what I put in front of clients, and I'm going to continue to put in front of clients, is that we have different theories working, and it is one that is difficult to find because, and I'm not asking you to defend it, even though maybe the question will come out as defend it. I get the question, well, aren't we always behind if we stop loss out? What about the whole don't sell low, sell high, buy low? Aren't you going against that kind of thing? Are you going against that?
Yeah, compared to, a true buy and hold. I mean, we will never find the exact top. I figured that out a long, long time ago. And, there have been a lot of strategies over the years, that fall more into the category of market timing. And they really do try to pick the top and the bottom. Unfortunately, what happens, they just don't get it right. If we look at, the results of managers out there in the marketplace, 80% underperform whatever they're trying to beat. So it's become very clear that it's kind of a fool's game. But, in our case, what we're trying to do is give the market enough room to roam. We know that it does, go down sometimes, and sometimes that's a very healthy thing. So we choose 10% because we know that that's a tipping point for the market. We've got data on the markets, the stock market, as you mentioned. I should define that better. The stock market going back to 1890. So during that time frame, when it falls by 10%, that gives you a roughly 50-50 chance of the market dropping into a bear market. So once it drops by 10, that means it's 50% of the time it's going to end up dropping 20, 30, 40, 50. 2008, by the time it was all said and done, 58%. So that is going to happen. The average works out to be about 35%. So that's what we're trying to protect against, is those catastrophic losses. And I'll probably be one of the few or only maybe managers out there that tells you, yeah, I know I'm going to be wrong. My process and strategy is going to be wrong about half the time. Because when I said, 50% of the time it turns into a bear market.
50% of the time it does not.
Yes. So we're providing value in those times. When it's just a blip, let's say the market falls, 10, 15%, we will end up a little bit behind. It's not that you're losing money. You're just not making as much as you could have. Right. It was a false alarm, and you probably should have just hunkered down and, come out the other side. But, I have a client here. I mean, this is Ohio, so this is tornado country. And they always say, when that tornado alarm goes off and the sirens go, you pay attention to it. You get home, you hunker down in your basement, in your little storm shelter, whatever you got. And, most of the time it's nothing. But if it is something, you don't want to be flying around the sky. So that's what we do.
And I'll summarize that with the way I like to state it is that when you're wrong, you're a little bit wrong, but when you're right, you're really, really right, and that is valuable. There's so, and I like that, and again, for the benefit of, and we work with you've met the other firms. I've introduced you to the other firms that I work with. That's why your concept is one of the concepts that we work with, or theories that we work with, because it's not. Nobody is always right. No one. They'll tell you they are, but we're not going to do that because it's not accurate. That's why we mix different investment philosophies into accounts for most clients. Again, for the compliance part of this conversation, for most clients, we're mixing in other firms with Beacon Capital Management because of the fact that at certain times, certain theories are more correct than others, or less incorrect, if you will. So, I always appreciate the candor that you bring to the conversation. And with that, coming up with just about 5 minutes or so to go, we decided we were going to add estate planning into this conversation, and something that I was hopeful you would touch on as you are a former financial advisor turned asset manager, have been through estate planning. So the conversations are real as it applies to client work. Talk about Beacon Capital Management, the step up in basis, the overall estate benefit, because with the market environment that we've been in, and with the benefit of this stop loss that Beacon has, we've built a higher floor under portfolios over the course of the last 13, 15 months. Increases the estate planning need and even possible liability. So if you would talk about that for a few minutes.
Yeah, estate planning is one of the most overlooked areas of financial planning, and one of the most expensive to overlook. When it's all said and done. So, in this particular case, we're looking at what's happening in Washington to kind of bring the conversation full circle. And they're talking about taking away, the step up in basis and things like that. That's enormous. Lou just, referenced, in our case, the market has been on a nice run here, and we've been participating the entire time. So just look in the last year, it's 30+%. So, that's a big difference, for estate planning. So you definitely want to go through the exercise to figure out ways to minimize that effect for your heirs. Most of us, we probably feel like we pay enough taxes. We'd like, whoever our beneficiaries are to get as much as possible. So, it's just the way it is.
Right. And as it applies to estate planning, to taxable, and this is, we'll call it, it's actually not a topic for those listening now or those listening after the fact, because we're under the premise that they're no longer here to do the planning. Planning's got to be done, we'll say now, during our lifetime. So it's an important conversation. Beacon Capital Management. I've had this question because of the concept, because of the stop loss, because of the 9.10% per holding. Still receive the step up in basis. That's still part of the conversation, correct?
Yeah, absolutely.
Mm-hmm. All right, yeah, and it will remain so. And there are some other concepts out there that will become a little more attractive if and when individual tax rates do increase. So, Chris, any final thoughts that you can share with everyone, market-wise, your opinion? I know you're not a market predictor. That's not, again, the concept of Beacon. However, what you're looking at right now or paying close attention to from, we've covered taxes, we've now estate planning, we've talked about the concepts. Tell me what you're looking at right now.
Yeah, well, I think, this particular webinar, I guess, is very, very timely because a lot of the things that, I was worried about have kind of come together a little bit, here recently. So, the Fed has given the market a lot of direction on what they're going to do with quantitative easing and then interest rates into next year. So the market kind of knows what's happening with that, and they're pretty happy with it. So they're going to do well there. We know that, the spending bills that we're working our way through Congress are going to be, much less, intrusive to investors than what was first, anticipated, on the corporate tax side, as well as the capital gains for individuals. So that's a big plus as well. We also are starting to see, I guess the headwinds from COVID, Delta specifically, in terms of shutting down, different regions of the country or slowing things down. Those positivity rates are all starting to fall, pretty fast again. And it looks like it's kind of gone through its cycle. Hopefully there's not another variant that comes in just as strong, but, as of today, everything is looking good. Most of the companies have reported their earnings for the quarter, all, by most accounts, pretty darn good, on a whole. So, I'm pretty positive on the market if I had to look out, forward. Obviously, I'm not a forecaster. I'm probably about as good at it as anybody else, which means we're not very good at it. But that's okay, because I know my own accounts are invested in the same strategies that you guys use. So I know I have these protections. I have these stop losses built into my portfolio so that if I am wrong, I'm protected. But I'll take this run up as long as it'll give it to me.
Sure. Now, I don't think anyone in this conversation would disagree with that concept. So I want to thank Andrew and Alina again for sitting in with us, TFA interns, Andrew, the finance intern, Alina, the communications intern, everybody on the call now. Thank you again for joining us. I always appreciate the support, and certainly, Chris, thank you for the time, the thoughts. They're always insightful. There's always a little something that Beacon Capital Management brings to the conversation that we didn't know even about or talk about in detail at the last one about the way that you're managing money for clients. So thank you for that. I'm going to share my screen again, post the disclosure, because that's what I am required to do. And again, thank everybody for joining us. We will likely not do this again before the end of the year for, we'll call it a long form video, but please look out for Alina and Andrew's emails and additional short form videos from me on some planning ideas. I believe the next one that we're going to send out, Chris, has to do with the SIPC insurance versus the FDIC insurance. So an interesting topic, at least to me, that a lot of people don't talk about. So look for that in the next few weeks. And thank you all for joining again.